All right, so with it being July 1st, officially the first half of 2020 is behind us. And we all know how crazy it's been. Hopefully, it can't be any more crazy than that going forward into the second half of the year. Hope for better things to come. But especially with this quarter and as strong as this quarter has been in the past, that's usually led to another good positive quarter or two coming out of it going forward from here. Now there is an election and a lot of uncertainty around the election. So we're going to talk about our short-term expectations and how that leads into seasonality and then eventually and how that jives with our longer-term expectations going forward from here. So we're going to break down the technicals as we always do, and we'll take a look at key move in some of these other markets in the risk trade and talk about what they're saying in terms of our direction for risk appetite or aversion going forward. And then we're going to take advantage of a big mover in the last few days for a trade with our trade idea of the day. So let's go ahead and get started. Today is Wednesday, July the 1st, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P with the market forecast indicator first, and you can see how we're back to dark green shading in the green line. So the bounce has continued. We haven't, we're off the 0 to 23% area. We're still, in that area. We're back up to that 78% line of the drop, right? So this is where we had, broken up above it with this little island reversal, came back down below it, hit this 23% retracement of the rally. And then we've been trading in between those two areas, the 23% retracement of the rally and the 78% retracement of the drop, the previous drop. We've been kind of sideways, haven't broken through one or the other for that matter. So we'll see if either one of those breaks this time. Of course, breaking above the 78 is something that's already been done by the NASDAQ 100, right? So it has come down, broken through the 78, and broken all the way through the 100, and is working its way potentially up to that one. It's got some lots of room to go, though, so it's not going to happen anytime soon. But you can see how we came back down to the 100% mark. Still didn't even get to the 23% retracement. So the NASDAQ still hasn't made that drop, and eventually we might have to move this up even more as it continues to form new all-time highs. Russell 2000, on the other hand, it got back up above its 23% retracement, got back above the 62% retracement of the drop. But now, again, we're still in this zone where we haven't really broken out yet. The 0% actually coincides here with the 78% retracement, and that's where we hit. So the Russell is still showing a lot of relative weakness compared to, say, even the S&P. The intermediate lines turned up. Obviously, we have the dark green shading again. So back to a bullish combination here. The near-term lines got into the upper reversal zones. Very good sign. It didn't do that over here during these last two peaks, but it did now. So that's a good sign. Obviously, you want it to stay up there. The longer it stays up there, the more likely you get a 7 to 12 day near-term rally. The momentum line dropped, not surprising because it was a small range today, very small range today. But it didn't drop to extreme lows, so it's not too big of a concern. It can trade around this 50 mark. It did get up into the reversal zone yesterday, yesterday. It did get up there, and that's a good sign because that's again the highest momentum line close that we had since way back over here. And we've had all these extreme lows, and we just barely came off an extreme low. So a very good sign that we got. At least it didn't have to be an extreme high. It came really close, but it didn't have to be an extreme high. But it has to at least be, get into that reversal zone to show how strong that trend is. So that's a good sign. A good sign for the markets, at least in the short term. Again, but I'm not expecting a new intermediate run here. At least a near-term run. Again, 7 to 12 days. We're talking, 1 to 2 weeks from a market trading standpoint. Remember, Friday this week we have a market holiday, so this would be going into next week, potentially the week after. Remember, the seasonality for stocks in July is to be bullish going through the holiday into July expiration, and that's generally when volatility bottoms and starts to rise from that point going into October earnings season. So, we have the potential for another couple of weeks here before we finally run into some seasonal weakness for equity, especially with the election coming up here. That continues to be uncertainty in terms of whether or not the incumbent will win, and market doesn't like uncertainty. The market doesn't really care one way or the other. At least in November it won't care, and November and December it's going to just care that we have certainty of a result. And right now there is no certainty of a result. And so the market in that situation tends to be more volatile. So we're already expecting a seasonal volatility as it is, and considering the uncertainty around the election, that will just be exacerbated. Not that we'll fall off a cliff and retest these lows, but that will be choppy. We'll have some choppiness and potentially trade between 0 and 38% up and down, especially considering how big the range is between 0 eventually, if and when we ever peak, right? Whenever that ends up being, and the gap between that and the 38 is going to be relatively wide. I mean, again, if the 0% goes, if we retest this high point all the way back up to that 33.93, then by then the drop from that level back down to where the 38% would be about a 15% drop in stocks, and that would just be a pullback, nothing more than that. So obviously the market's going to be kind of spooked, but you can kind of see the range for volatility without necessarily being bearish if we do get that seasonal trend over the next so many months after the next couple of weeks of we talked about, if we break here, then we're going to be weak, but if we bounce, then we might get a week or two more of bullishness. And that's kind of where we're looking to be now. We have bounced, and now we look to get about another week or two of bullishness, especially if we break through this 78 and push the 0 all the way up to these old highs again, like we already have done on the NASDAQ. We've actually pushed it up higher than that old high. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this subscribe icon right here. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That will let you know when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you like our video, and number two, that you want us to do another video tomorrow. It's a quick way to give us feedback. If you like our videos, let us know with one click. You can do it right now. If you don't like our videos, you don't have to click on anything. Also, while you're down there, comment. What questions or comments you have about anything to talk about in the video today? Let me know in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow us on Twitter for more content in between videos. You can see up there my handle is @DavidSaddle42. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, on our website at marketscholars.com, here if you're watching us through that, remember we also invite you to check out our Market Outlook Live. Every time I do the Market Outlook, I also do a live video on YouTube. I do those at 3:30 Eastern Time. Here's the link that you can get to it. It's hosted only on our site, so this is where you can get to it on any of the Market Outlook posts. You can also see it up here when you mouse over Market Outlook. You can click on Market Outlook Live Trade Review. There's the forum for the Market Outlook if you're looking for that as well. Here's our upcoming trading rooms. You can see this premium Q&A session that Brandon does, an online Q&A session with all of our premium clients. They can ask anything. Mine's usually on Saturdays, not for this week because of the holiday, but we'll be back on next week. And then there's my class tomorrow. That's one of the 8 trading rooms that we do every week that all of our monthly subscribers get access to. So plus subscribers, you can see a link to this as well right there. Our premium subscribers get access to all of that and the Market Outlook Live and all of our premium tools that we have available to you, including access to our community, all of our class forums. We also invite you to engage with us here on social media. Click that heart. That opens up a new window, and hit the like button there. Hit the thumbs up. It takes you to your Facebook page. We invite you to click on that like button there too. Again, the more you do those two things, the more that benefits us. It helps us because it gets that content out to all of our followers. And it also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, back to our charts, and let's take a look at the long-term chart. Again, we're relatively bullish, but you notice, again, another transition candle. So we're probably going to finish this week with another transition candle. Look how small that body is, which means next week the body will start there too, more than likely. But next week has the potential of being more of a bullish candle because that's right around 30.67. You notice we're trading at 31.15. So depending upon how we finish this week, we might end up with a bullish candle next week. Now you notice we're not getting new highs, and it is relative, but we're also not breaking the 23 or the 200-day moving average either. And momentum here is rising. All very good signs. You can see from a NASDAQ perspective, we've already been pretty darn bullish, and we're getting a relative a transition candle here, but that's going to turn into a very strong bullish candle because remember we're trading near the all-time highs on that next week, and very strong momentum as well. If you take a look at the Dow, though, you're not quite. We're kind of flirting with the 23%. We're not positive yet. We don't have that golden cross, and we don't have it yet on the Russell either. So you see how much more room for bullishness that we have from a long-term perspective, even if we happen to get any kind of weakness in the short term, which for the NASDAQ would just be simply just to come down to the 23% retracement. That might be all the weakness the NASDAQ gets if and when the S&P and everything else comes down below their 23% line and touches the 38% level. Let's take a look at the 3 green arrow chart. We're back to where we got 2 green arrows. MACD is really darn close. So if you look at the 2-line versions, getting above the 8-day and the 17-day was very important yesterday, and then today we're holding. So very, very good sign. The whole range today was above all 3 of those lines. The MACD has turned positive again, just barely, but it's turned. The blue line's gone up above 0. The histogram's almost positive, which means the blue line's about to cross above the orange. The stochastic already has crossed above the orange, and it's gotten back above 40, so it's kind of like a little bit of a false breakout here. So we have an opportunity to be relatively bullish now, and you'll see that in some other oscillators too. If you look at the RSI, we never did drop below 40, and we're making our way back above 50. We never did drop below negative 100. We're making our way back up in the upper half of the chart, so we never did really get strong bearish signals on the DMI. We dipped our toe below 20, but that was it. We came right back up above it, and we're almost back above 25. So, and then you look at the trend strength indicators. We never did cross below the cloud, and you can see we're back to a weak bullish trend and pretty close to a moderate trend again, and we're almost back above that blue line. So, and the red line here has stayed above the price, which is bullish, and you can see for it to continue to stay above the price, you can see the move it's going to make. So that's kind of the move I expect that we'll probably get in the next couple of weeks, and then kind of flirt around here before potentially coming back down post July expiration. Now let's take a look at the intraday chart. You can see how bullish we've been over the last few days to get up to where we've gotten back up to the point of control for the 4-week range. So there's a bit of resistance here, but you can see again breaking through this area how bullish that would be if we were to continue to break through. There's a big volume gap. We talked about that before when we were over here. Still there. So there's a big volume gap that we can make a run up to 320 again. If we're going to continue to get a week or two of bullishness, you can see how it's going to form. Otherwise, you can also see, we move back down. It's not going to be a free fall either because you got a lot of support in the last 4 weeks down below us. Today's move, a little bit of a, grain of salt, very, very small range, less than half, very small volume, 72 million shares trading. That's actually a good sign for both those numbers because it brings both these lines down, and the more they come down, the bullish that is. We're not quite below the 1% mark yet. We still got some room to run. We're still pretty volatile. The VIX has dropped down, but it didn't drop below the 90% mark. It's still in the high 20s. It's lower than we were over here, but not over here before we had that, at their peak in July or June the 8th. So we're not quite as low there, but we haven't broken the 90% mark. And, If we were to grind higher and this kind of stays around the 90% mark again, you can kind of see, what kind of a difference that's going to make. And you can also see from a VIX compression standpoint, if I were to go to this chart here and pull up the VIX again. So here is the VIX, the 3-day RSI, and the relative 3-day RSI. So it's still relatively high. So there's more compression for it to come down before we make a run up to the upside. So, which means that very small days, and when you get very small days, it's hard to get very much of a move to the downside. So don't be surprised if we don't get, again, over the next week or two, and more of a VIX compression before, by the time we get to July expiration, bringing the VIX ATR down to a lower relative level here, back towards that 10% mark, or maybe even a little bit below it at 7.5. Then we get our jump in volatility, right? Then we get our base in volatility for the year, for this part of the year, and we have our seasonal rise for the next few months. All right, so take a quick pause and just summarize our technical outlook. The trend is bullish. We're getting a little bit of a near-term bounce here. I do not expect a new multi-month run to come off of this bounce. But I do expect potentially another week or two, especially considering the seasonality of things going into July expiration. Then after that, especially with the election coming up, there's opportunity for an increase in volatility. Remember, because our move has been so bullish at the beginning of this year, a move from 0% to 38%, which was a typical pullback, a typical breather, would be a pretty tremendous drop. Like we're talking 10 to 15% drop. That would have a lot of financial media types up in arms about, here we go again, double dip recession or whatever they'll come up with. And in reality, it will just be a breather, an exhale. It's very, when the market drops 10%, 38% retracement, and people go nuts about, recession. That would be akin to every time you exhale, somebody think you're about to die, because you're not breathing in anymore. You're exhaling. And the reality is, you're always inhaling and exhaling. That's how the markets work too. So obviously there's degrees of exhale. So, but the normal 38% exhale, if you take a big deep breath, your exhales are going to be bigger. And so we have been on a tremendous move to the upside since that March low. Because of that, our exhale is going to be bigger, and we're not going to be dying. The market's not going to be testing new lows. It's just going to be exhaling, and a little bit more uncomfortable than you may be used to, but not very uncomfortable when you consider how big the move has been over the last so many months, both originally to the downside, then back to the upside, and then the eventual retracement pullback that we'll eventually get. So what do you think? Do you agree with that? Do you disagree? Let me know down in the comment section below, especially if you disagree. Share with me what you're thinking, what you're seeing. That kind of drives your opinion of why you're either a lot more bullish than I am, or you're a lot more bearish than I am. You're not buying this bounce here. All right, let's talk about how some of these other markets have done today, particularly the dollar. That's been a big driver here. And you notice it had gotten up to its 38% retracement in the last couple of days, and now it's pulling back down. And again, getting back below the 23% level would be a sign. Now, nothing's 100%. We did there too, but that would be your sign that we are re-engaging this bearish trend. The intermediate line got up to the market sentiment. Again, rolling back down would be significant in terms of its rollover. You can see too, from a 3 green arrow standpoint, we got up to the 30-day moving average. We got above the 17 briefly. We're right back down. Within a couple of days, we're right back down below the 17, and for that matter, back below a falling 8-day moving average. The MACD is coming back down. Stochastics is coming back down. So you can see how things are kind of rolling over, and that's pretty significant for stocks to have a falling dollar. It's really bullish for risk appetite as a whole. In fact, if you look at TLT, you can see again, this is another kind of a function of risk appetite. It was above its, this little pullback in equities. We've had this got back above its 8-day moving average, got above the 17. Both the 8 and the 17 got above the 30. But now we pull back down below the 8 and potentially flirting with the 17 and the 30. The stochastics falling below its moving average. The MACD histogram's rolling over with that MACD dropping down. You can see from an RSI and a CCI standpoint, we never did get above 60, which signifies bullishness. We're back below this 23% retracement level, working our way back down towards support. The retracement, if not into the retracement zone. We did get above 100 briefly, but we're working our way back down. So the safety trade is not nearly as bullish. And when you look at, say, like commodities, in fact, let's look at crude oil. You can see it staying above 60, crude staying above 0 easily. And you look at its market forecast, and crude oil is, dark green shading in the green line still. And you look at it on the MACD and stochastics, and you say, okay, we're still above or rising. We never did really get below 17, and we're back above the 8, and we're rising up above it. And the MACD is negative and still has a chance to go positive while we're riding above the 8 day. The stochastics easily above 60. So we're maintaining some bullishness in these risks. And the safety trades. Now gold's popped back down, but gold can stay bullish even with stocks rising because of the weakness in the dollar. If you look at because of the weakness in the dollar, another function of that is some strength in emerging markets. So emerging markets have been relatively bearish, and if you look at it from a long-term perspective here, as bullish as the S&P has been, emerging markets are just starting. Again, we don't have the golden cross yet, and they're just kind of getting to the 200-day moving average and trying to stay up above it. And for a few weeks now, we have confirmed that. EFA has been a little bit more bullish, but it's still below its 200-day moving average because of the recent pullback it had after getting strongly up above it. So you can kind of see, there's these international stocks are, not necessarily in one day at a time, but the trend for these international stocks is looking stronger and better for a rotation into that area. If I were to look at, let's see here. Nope, sorry. It is this one. And let me do this compared to a broad international basket of stocks here, ACWI. So if I'm comparing the relative strength, you can see, they both have strong momentum, much stronger than the S&P. If I were to include IWM in this, small cap stocks, you can kind of see, that's even stronger. But these international are doing much better than the S&P. And EFA had been stronger, but if you notice, just in the last 1 week, sorry. If I can get it to 1 week here. There we go. In the last week, you can see a bigger move on EEM than what we have on EFA, so stronger jump in momentum. They're both moving to the top right. SPY is moving to the bottom left. So that means rotation into international areas and small cap stocks with a lot of momentum and moving far to the right. So small caps are going to continue to kind of give us an opportunity for strength relative to, even if I were to include mid caps as well, you can kind of see again the strength that we have here in mid caps and small caps relative to large caps. Here's the 12 grid for the major economies out there, and you can see everything's kind of bouncing up, but except for a few areas, pockets of weakness, like Japan, China, Korea. These Asian are still struggling. India is doing well. Europe, especially in France and Italy, are doing well. Germany and UK still kind of struggling there. Brazil's bouncing up off of that, so South America's looking pretty nice. Canada is maintaining some strength. Even Russia, it looks pink, but at least it's not got a nice good rally here and got a relatively strong for a pink. It's got the strongest intermediate line at 71. So you got some pockets of strength and some bounces everywhere else. So it's looking like, from a broad global standpoint, that this light pink shading yellow line pattern in a lot of these areas are playing back out into, like it did on the S&P, back into dark green shading and green line patterns. All right, now let's take a look at how the sectors have done. So let me pull this up here really quick. Give me 1 second to do that. Right here, our sector comparison first. And then let's just look at so far this week. So we'll go into June the 29th and up till now. Do a 10-minute chart here. And you can see, look at communication services doing this, Facebook kind of making a really strong run after a bad week last week. So communication services, discretionary doing well. Industrials and energy did okay at the beginning of the week. Financials a little bit too, very, very early. But then you can see energy and financials not having a good day today. Staples also, which was strong early, has pulled back along with materials. Even with a little bit of a drop in the dollar, they're not doing very well today. And then technology kind of lagging. If I just look at today, you can see how that looks like. Right here. You can see how, again, utilities and real estate, interestingly enough, rallied up along with communication services, which has also got an interest rate sensitive area in that market. And then on the other hand, your cyclical areas, financials, industrials, energy, all lagging behind. So, again, like, it's not the most bullish pattern here. And so that's why I say, again, if we're going to be bullish here, we're not looking for a strong 1 to 3 month run. We're not getting cyclical leadership. So, again, maybe a week or two of some kind of odd rotational leadership before we get more of, the pullback where we finally do break that 23% retracement. Again, seasonally around the time of July expiration. All right, so for today's trade idea, I wanted to take advantage of this move, particularly in Facebook, this 3-day rally. We've kind of set a low point and we bounced right back up. So, this is like a light pink shading and yellow line pattern to the extreme, right? We got it, and then we bounced up the next 3 days, and we're back to dark green shading and green line, just like that. Near-term line taking off, and very good sign for Facebook, as considering, again, not expecting big strength going forward to the upside, but at least we set a low point on the downside. If you take a look at the 2-line version of its 3 green arrow charts, you can see how bearish we were, and then boom, but 3 days later we're back above the 17-day moving average. MACD is turning back up again without the moving average falling below 0. Stochastics is turning back up without falling below 40. You look at some of these other oscillators on Facebook. We came down to 40, we didn't break it. We came down to negative 200, we didn't break it. We're back up above the chart midpoints there. You look at the DMI, the positive index dipped, it's still below 20, right back up above 30. The positive still above 30, so there's still some room for some upside potential. It's Ichimoku trend for the stock. We came down, touched the cloud. We bounced right back up to moderately strong bullish trend levels. Because we were so strong here, you wouldn't expect a repeat. You'd expect something where we're kind of weaker here, where you get a good run and then you're just a little weaker. So that's something I expect going forward from here. Some bullishness, there's some support in this area, and then you just expect some weakness. Some grinding moves to the upside. You can see the Bollinger Bands. You got very strong support below now with this volume node. That's where we hit the support. You got path of least resistance to the upside. So you want to have some room to the upside of the trade, but you've also know where your room is to the downside because we just set it. So that sets us up for doing an iron condor trade on the stock. So if we were to take a look at Facebook here and you say, okay, if I were to sell the 210 at the 20 delta, buy the 205 for protection, sell the 270 at the 20 delta, and buy the 275 for protection, that gives me pretty decent credit. So relatively widespread now, wasn't as wide in the when we did it during the Market Outlook live session. If I were to, just go over here. If I were to put it on, there's the trade that we did. So we got for a relatively normal risk, we position size for normal risk, even with the earnings. We feel pretty good about the range that we have set up to the upside and the downside on this. you get a pretty decent reward, over $500 for that $900 of risk. So that means out of the 975, I don't want to lose more than 525. I don't want to lose more than what I'm trying to make. And then as volatility rises, that's going to put some pressure on this throughout the earnings. But remember, when volatility earnings is through, then volatility will drop sharply, and this is a negative vega trade. So you would expect that purple line will jump up. It'll put some pressure on it until the earnings, and then after it will pop up. The purple line will pop up because of the drop in volatility. It's just a matter of where we'll be if and when that happens. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forums. Open up any new thread, reply to anybody else's thread. Let's talk about what we covered here in the video, and keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, join our website and our community at marketscholars.com. We are now 2 years old, going forward from here. So starting our third year, officially starting our third year. We had a kind of a soft start before, but this is our official start 2 years ago. So join us for the next 2+ years going forward from here. We are looking forward to many more years to come with you all. Then also just follow us on Twitter and other areas there for more content that we produce. So again, thanks for watching. Have a great rest of your night, everybody, and we'll see you all next time.